Welcome to AM Best Audio.
This is a special edition podcast from AM Best Audio. Ann Modica and James Creedy-Smith from Credit Rating, Criteria, and Research at AM Best sit down to preview two pivotal central bank meetings on the calendar: the European Central Bank decision on June 11th and the Federal Reserve meeting on June 17th. Now here's your host, Ann Modica.
So James, the ECB hiked rates by 25 basis points earlier in June, and this is the first rate hike in almost 3 years. In your opinion, what caused them to tighten rates?
So I think there are a few reasons why they've tightened rates. First and foremost, their updated baseline forecast has inflation rising to around 3% this year. It's above target next year. It has core inflation sticky at around 2.5% for this year and next year as well. So, based on these figures, their own data is saying that inflation is rising, and they're going to want to respond to that. I also think that they're thinking not just about the baseline forecast, but some of the risks, the upside risks to inflation to that compared to that forecast. So, we know from 2022 and post-pandemic that inflation can develop in a very non-linear and sudden way. And so I think they're wanting to make sure that we don't get a repeat of what we saw a few years ago, especially when, interestingly, they talk about how some of the models they use for their forecast could potentially be outdated and in ways that downplays the risk to inflation, which kind of brings me to my second point of why I think they've hiked, and that's because they're conscious of the risk that we live today in a more inflationary world than we did maybe pre-pandemic. And so, people are more aware of rising inflation. They're forming expectations and bargaining for wages in a way that's different and in a way that's more inflationary. And so they're trying to ensure against that risk. And there is some evidence for this. If you look at data on how much attention people pay to inflation and inflation expectations rising post the outbreak of the war in Iran. So I think they do have. There's some evidence to support that idea that we are in a more inflationary world, and they want to protect against that. And finally, I just say, kind of undercutting all of what I've said is this fear about their credibility. Again, bringing it back to what happened post-pandemic, where they let inflation get away from them. And so I think they're really concerned about not repeating that and convincing everyone that they are on top of things when it comes to inflation.
Yeah, no, that's fair enough. And so I guess, what are you expecting for monetary policy decisions for the rest of the year? Do you think the ECB will continue to tighten rates?
Well, at this point in time, yes, I think they will. I think at least one more hike would be my base case. And I think markets are still fully pricing 1/4 point rate rise from the ECB by the end of the year. I think at this moment, the debate is more about whether they do another one. And I think the chances of a second hike have fallen recently as you see energy prices decrease and some normalization of oil flows through the Strait of Hormuz. Having said that, there's not to say there's zero chance of no hike. And I do think the ECB does need to be cautious with how much it tightens. So, for a few reasons. Firstly, 2026 is not the same as 2022 when it comes to the potential for this shock to energy prices to become really embedded in the economy and to become more widespread as an issue. And if you look at a whole bunch of different variables like the labor market or the level of existing inflation and just the strength of demand in the economy, all these things that kind of determine how embedded a shock to energy prices becomes. Across most of these, Europe is in a better place now than it was in 2022. And I mentioned earlier about that the worry that expectations have become looser and people have that memory of post-COVID inflation still fresh in their mind. And whilst that is true, I think you could also argue that if inflation expectations are more sensitive and they're less sticky, there could be a chance that they come down more easily as well if consumers and firms see the price of energy decreasing and they see positive developments on that front in the headline. So yeah, even that is not necessarily a slam dunk argument. And finally, I'd just say on growth, because growth in the euro area is so weak, consumer confidence is way down. I don't think there's going to be much consumption smoothing as you potentially may see in the US. The latest data on manufacturing and service PMIs is pretty weak. Because of that, I think that's going to limit how much the ECB is going to be able to tighten policy further going through the year.
Yeah, no, understood.
And so turning it to you, Anne, we recently had our first Fed meeting under the new chair, Kevin Warsh. What did you make of the meeting and of Mr. Warsh?
Yeah, so it was an interesting meeting, wasn't it? And I think Warsh appeared to me, at least, that he was trying to set a tone for the Fed. And to me, there were two main messages I think that he wanted to get across during his first meeting. And I think the first is that Warsh, he seemed focused on establishing credibility early. I mean, particularly around inflation, and avoiding any impression that a change in Fed leadership meant that the Fed was preparing to ease policy quickly. And I think in that sense, he probably came off somewhat more hawkish than I think some people were expecting. And I think he was trying to show that the Fed would remain willing to keep rates steady and, if necessary, respond more firmly if inflationary pressures kind of prove to be more persistent. And I think second, Warsh seemed intent on signaling that this would be a new chapter for the Fed, that this was his Fed now. I mean, we saw it immediately with the shorter press release and no forward guidance in that press release. And rather than giving markets a pretty specific roadmap of where they saw interest rates and GDP and inflation, at least for him, he appeared to be emphasizing more flexibility and more a meeting by meeting approach instead of getting trapped into forward guidance that the Fed has given in the past. So overall, I will say the meeting was, for him at least, was less about a major policy shift and more about Warsh establishing his credibility, his communication style, as well as his independence as the new Fed chair.
Customize your data experience. BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
Yeah, that makes sense. On those points, there was so much speculation prior to coming into the first committee, Warsh's first committee. And so now that we've actually seen him in action as a chair, do you think we have a sense of what to expect going forward in subsequent meetings?
Yeah, there was a lot of speculation, right, going into Warsh's first meeting. And I think the main takeaway that we can have here, and I think going forward, is that he showed he can sound credible and hawkish on inflation. But I think the bigger question is whether he's prepared to follow through if inflation remains sticky. I mean, and this isn't his fault. I mean, he inherited a Fed that has an inflation problem, right? I mean, at least relative to its own mandate. I mean, the Fed's preferred measure of inflation, the PCE, was 3.8% year over year in April, while core PCE was 3.3%. These figures are well above the Fed's target of 2%. And this matters, right? Because when inflation remains above target for an extended period, markets and households can start to question whether the central bank has the willingness, the ability, and the ability to bring it back down into target. And, if you look at it, the Fed is going on 6 years now where inflation has overshot their own target. So, Warsh, I think going forward, Warsh has historically had a more hawkish bent, and he has often argued that, inflation is a choice. He has said this a million times. So going forward, I think the key issue is whether his philosophy, his hawkish philosophy translates into actual policy decisions if, inflation does remain sticky.
Mm-hmm. So then I guess the big money question is, do you think that given all of that, the Fed will raise rates this year?
Oh, wow. You really put me on the hot seat, aren't you? So I do think a rate hike this year is a real possibility. If you look at the updated dot plot it showed that 9 members are penciling in a 25 basis point hike, and with 6 of those 9 members penciling in a 50 basis point hike by the end of the year. So, while a hike is not a guarantee, I think it's clearly a distinct possibility. And if I were a betting woman, I would say that the Fed is going to hike rates this year. And, I think if you look, take the overshoot in inflation for the last 6 years. And then if you look at the updated projections for this year, the Fed is moving in a hawkish direction. If you look at their inflation target, their inflation ranges in the last summary, they are elevated. And I think that will put pressure on them to hike rates this year. So I guess I'm going to move it back to you, James. I'm going to put you on the hot seat. So what is the one thing that you have your eye on for the rest of the year?
Yeah, I think for the rest of the year, probably the main thing I'm going to be looking at is, does wage growth in the euro area continue to remain contained? At the moment, the ECB has a wage tracker, which kind of monitors what wage growth in the European economy is doing. And they're currently expecting it to level off at around 2.5% for this year, which feels pretty okay. That doesn't really feel too inflationary. And I think if a lot of the stuff that I talked about living in a more inflationary world and the ECB's fears around that, if those are to come true, then what you need is the shock to headline energy prices to start to feed into people's wage bargaining and wage negotiations. But at the moment, we're not really seeing that. Now, it could just be that there's a big delay in effect, and we will see it. So I think that's definitely going to be one to watch for the rest of the year.
Yeah, I think that's a good one. Yeah.
For you, Anne, same question.
Oh gosh, I don't think I can limit it to just one, but I guess I'll try to limit it to 2. So I think, oh wow, the first one I'm watching is how markets adjust to Warsh's communication style. He does seem much more reticent than some of his recent predecessors. And, he has been critical of forward guidance. I don't think we're going to see a ton of that. And I think this is a real shift. And, forward guidance became more prominent under Bernanke during the global financial crisis and continued under the later Fed chairs. But before that, under Greenspan, markets were often left trying to infer what the Fed was thinking, right, from their very limited signals. I mean, I remember even things like the color of Greenspan's tie or how full his briefcase looked, right? Like all these analysts and journalists were trying to look into what type of clues Greenspan was giving, based upon his tie choice or, how full his briefcase was. So I think that will be interesting. Looking for towards the end of the year. And then the second thing I'm watching is how Warsh reacts if the economy faces a major shock, right? I mean, heaven forbid that doesn't happen, but, he was very critical of past Fed interventions when he believed the central bank went beyond its role. So the question is, if markets come under real stress, does he respond with the same kind of force investors have come to expect from the Fed, or does he take a more restrained approach? And I think this ties into a more broader question of whether the so-called the Fed put is allowed, going back to Greenspan. I think markets have grown very complacent and used to the idea that the Fed will step in when financial conditions deteriorate. And I think if Warsh is less willing to do that, investors may really have to reprice risk in a very different way. But I guess we'll end it on that note. I think we do have a very interesting 6 months ahead of us with regards to both the ECB and the Fed. Thanks, James, for sharing your thoughts.
Of course. Thank you, Anne.
Thank you.
That was Anne Modica and James Creedy-Smith from Credit Rating, Criteria, and Research at AM Best. This has been a special edition podcast from AM Best Audio. Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.